afternoon, everyone. I'm Pamela Hastings, and welcome to another Barometer Readings webcast on this September 13th, 2022. On today's webcast, we will go into depth on the latest macro trends, especially today, given the market's volatility. We'll speak to that. And of course, as always, we'll be pleased to address your questions at the tail end of the conversation. So don't be shy. You can email me at phastings@barometercapital.ca or hit me up in the Q&A or the chat via Zoom. And with that, I'd like to introduce you to our very own David Burrows, our Chief Investment Strategist and President here at Barometer Capital, who will carry the conversation from here. Good afternoon, David.
Hi, Pam. How are you?
Great. Thank you. Nice to see you.
Good to see you too. Good to see you too. And we want to welcome everybody who's on the call today. Good reason to be on the call. It's been a sloppy day in the market. The CPI data came out this morning. I think many hoped that it might be a little bit cooler, and it came in just ahead of expectation, up 0.3. Some internal parts of the CPI data were a little bit more troubling. The food and shelter, the shelter component was a little bit firmer. Healthcare was a little bit firmer. Those tend to be a little bit more sticky, while the energy component was down some, and that certainly has helped. But it continued to came in a little bit more hot. That pretty much seals a 75 basis point hike at the next Fed meeting. We don't actually have any Fed speakers until the next meeting. They're now in their blackout period. But you could see in some of the indicators, it opened up the potential for 100 basis points, which I think is probably unlikely, but certainly the market was hoping for something better. So there probably hasn't been a time where you needed to be more tactical than the market that we're in. There are parts of the market that are having a really tough time. There are parts of the market that are doing markedly better. And it's an important thing to understand the backdrop that we're working against to make sure that portfolios line up with what's actually going on out there in the market, as opposed to what we might like to see. Now, it's especially tricky because some of the parts of the market that have been favored for a very long time are having a hard time. Some smaller parts of the market, which arguably are underowned and arguably very inexpensive, are behaving in a way that you wouldn't expect, given the thought that this could potentially see the economy slow down more than we want or expect. So let's go through some of the data. So as always, let's just start off the top. Until proven otherwise, we do believe that we continue to be in a structural bull market for stocks, which means that we get sort of 3 to 4 steps forward for each step back. And as I always say, the steps back are always painful. They always last a little bit longer than you think or go a little bit deeper than you think. But it's important to be there when the strength comes back, because it happens in a hurry. It's far different than if we're in a structural bear market like the period between 2000 and 2013, where the S&P really made no progress. And there were 2 very deep declines, very structural bear markets, 45, 50% pullbacks. Those are the kinds you actually cannot afford to sit through, because even if you think you're a long-term investor, if you're down 40% at some point, lots of people say, I just can't afford to lose more money. I have to move the sideline. So we've always felt that it's really important to understand the structural backdrop to help us structure portfolios, because the fact is we don't want someone to sit through a 40 or 45% decline. We do have to be able to mitigate it, and we do have to be able to get people to the sidelines through periods like that. And so we've had periods like 2000 through 2013. We had period 1966 through 1982, where the market was tremendously volatile but made no progress. We had the period between 1929 and 1951. Again, lots of ups and downs and places where you could take advantage if you were nimble, but certainly there were some parts of the market that really could have hurt you. But until otherwise shows us, we do think that we continue to be in a structural bull market. You can see in green, this is a long-term 200-week moving average. You can see once you're in a structural bull market, you tend to stay above this level, and we did all the way through the 80s and 90s. Really, since 2013, we had one brief dip below in the COVID sell-off, but very quickly popped right back up and above and have continued on ever since. So in time and in price, this continues to line up with what we do see during a structural bull market. But of course, we're always watching for clues that maybe something's changing. Looking at it another way, if you look at the spider, we've been in this channel ever since 2008-9, and we continue to be. We've been at the top of the channel and we've been at the bottom of the channel, but we continue to be in this spot. Looking backwards, this is the June low, June 23rd, which is considerably lower than where we are today, but we are certainly testing. And we've talked about the fact that seasonally, we're in a tough time of year, and we're likely to chop around over the next little bit. When we look at a little closer view, the S&P rallied off the lows June 23rd, rallied up into the declining 200-day moving average and the downtrend that had been in place since January. Our sense was because it was a downward sloping moving average, we were running into trend, we were likely to see some sloppiness, especially because we were very extended above the 50-day moving average. And we talked about that over the last couple of weeks. When you got so extended, 8-9% above the 50-day, very often the market would come back in over the next few weeks or a couple of months. And certainly that's been the case. And then we bounced over the last 7 or 8 days. Today was a tough day. If you look at the S&P, about 3 o'clock, it was down 3%. I think it was down a little bit more than that by the end of the day. So now we're in this range. Upper bound by the downtrend from January, lower bound for the uptrend that started in June. And so ultimately we will resolve one way or the other, likely as we get through September and October. And that'll give us a very good clue as to the type of environment we have going forward. But as it is right now, I think people know that we've had some cash in short-term bonds on the sidelines. And we've been very choosy about the spots that we've picked because, of course, what's going on inside the S&P is very different than the aggregate of the S&P. We know there's some very large tech weights, which can have a big impact on the market. We know that there's some strength in some of the sectors that are very small, but may not have that much impact on the index. So we like to spend time digging down underneath the surface to see which groups are stronger, which groups are weaker, and look for change. Now, getting away from equities, because there's one asset class, we have to recognize there are other places to be. And just like there's structural bull markets in stocks and bear markets, we get the same in commodities. So we've talked about the fact that since 2020, we've started to see some improved relative performance versus stocks. So this is the commodities to equities ratio. The last time we saw a shift that was important was the end of the 1990s. And commodities structurally outperformed all the way through until the financial crisis. The same situation happened from the early 80s through the early 1990s. And the same situation happened from 1972 through until 1975 and the oil embargo and the inflationary bust. But when they get going, they can go for a while. And so far, this seems to be continuing. This is the RJI, equally weighted commodities index. That's a Rogers Commodities Index made up of a basket of various types of commodities in a bear market, very considerable bear market, all the way through until 2020, when ultimately we broke that downtrend and month by month marched higher. Now, we certainly have corrected over the last 3 months, but on a relative basis versus stocks, a very muted pullback. If we look at the daily chart for the RJI, we can see that we did pull back starting toward the end of the equity sell-off in the last month. But since the market bottomed, it's been working its way higher on a relative basis. And frankly, while the S&P, including today, was down sharply, about 8% or 8.5% off the recent high, we're about 3% off the high in the RJI. So we have to pick our spots and understand what may perform better and what may perform worse. My thought has been recently that there was a lot of front-end loaded selling by funds in commodities, expecting that if rates were going higher, the economy may back off. But that ultimately, because there is a structural shortage in a lot of these commodities, ultimately the selling may become muted. And in this most recent pullback in stocks, commodities have been surprisingly resilient, perhaps signaling that there's a little bit more inflation than people are hoping for. But certainly worth noting that that continues to be the case. And even on a really bad day like today, the RJI was down something like 65 basis points versus the NASDAQ down 5.5%. So as we work our way through the commodities group, the most important group for investors in general is energy. This is the BNO, which is the Brent crude ETF. We know it came out of a long bear market that goes back to 2015. Rallied, and it's been consolidating above long-term moving averages, trading better than 89% of the companies in the S&P. And interesting, today, Biden came out and said, perhaps if oil were to pull back to $80, we might like to be a buyer to replenish the strategic reserves. Well, markets love to hear that there is potentially a giant buyer in the backdrop that may stand in and start buying. That gives them license to own with what ultimately looks like a put underneath, a put for them or a backstop for them. And so, in fact, oil pulled back to $85 and through the day strengthened closer to $88 by the time we started the webcast. Outside of energy, agriculture done the same thing as the RJI index. It's been working its way higher, certainly consolidating over the last 2 months since June, working its way higher again. In fact, the relative strength versus the agriculture group versus the commodities group, agriculture has continued to improve. So if we take a look at all of the commodity groups, it now is that agriculture has the strongest relative performance, energy second, precious metals third, and industrial metals fourth. Well, carrying on that asset class examination, I wanted to just touch on real estate quickly. Now, I can't plot residential real estate, and I could plot real estate investment trusts, or we could plot real estate development, but all of them have been seeing weakening relative price performance since early in 2020. We talk about the fact that when you get a structural shift or a generational shift, for instance, in rates, the things that have been helped by falling rates may be hindered by it going forward. And when we look at real estate, because it's a levered asset for the most part, if rates are going higher, the cost to carry is going higher and makes it very difficult to have structural revaluation upward. You're going to get downward valuations. And so our view is, based on what's happening, markets telling us exactly that, relative strength continues to wane. What has been seen as a safe asset has been relatively unsafe this year. The various real estate subsectors of the market down in excess of what the S&P is down. So look, we have very open mandates at Barometer. We can go anywhere. Our job isn't to be everywhere in the market. It's to pick our spots, to identify big structural themes that due to some change in the underlying economy, valuations get a tailwind. And our job is to focus in those areas. People hire us because we use these tools to try to identify which assets have a tailwind and which assets have a headwind, so that we can skew our portfolios to really look quite different than the market. Now, it's been a great world for passive investing because you've had a tailwind the size of a hurricane across all asset classes. But rising rates changes that picture. And we really have to understand that and understand what can happen and what is happening. So we don't need to be everywhere. We need to pick our spots. We need to focus in areas of market leadership without any kind of bias or backward-looking view. We have to look for change, old leadership to recede, new leadership to step forward. In the absence of leadership or extreme volatility or correlations, be prepared to play some defense. And there's a combination of all of these things at play right now, but it's an important time to be tactical. And we think that that gives us an advantage over the passive investor who says, I'll go with the tide and hope that my recent past will be my future. We have 3 sets of tools. Our goal here is to use process to make decision as opposed to opinion. We know that through various studies, it shows 80% of return comes from getting the asset class, and getting to rate sectors within those asset classes or in other words, get to the right neighborhoods. 20% of return is finding the right securities to use to express your view, single securities. And while we think that that's really important, we need to understand this macro picture. So we have two basic pieces to construct portfolios. We have our macro top-down work. And in that, we take all the investable universes we could focus in. We drill down to identify those that are seeing net inflows of capital, and we define that by finding sectors or themes that are showing expanding breadth or increased participation of leadership. And then we look bottom up. We take a 60,000 security universe, drill down to identify securities that have both positive fundamentals, good getting better, and strong technical characteristics where the market doesn't disagree with what our fundamental view is. We're looking for strong fundamentals, strong technicals, and where we can find securities that meet our business tests and technical tests, then they line up with parts of the market. You're seeing net inflows of capital, where that's where our portfolio should lie. That's a living, breathing process. We run it every day, every security we valued and we looked at every day. And a very important part of the process is having a disciplined selling strategy. Because what's good today may not be good tomorrow. And our most important job is not to let a little mistake turn into a big one. So we run stops on all of our positions. As positions work out as we hope or expect, we'll ratchet the stop losses up and behind. So long as a position works well, that's great. If at some point it stops working and starts backing off, whether we're protecting gains or trying not to lose money on a new position, we'll hit our stop and move to the sidelines. There's 60,000 securities we can choose from. One very legitimate security is cash. Portfolios look very different at different points in time. So ultimately, from a top-down perspective, and we've talked about this before, we look for parts of the market that are seeing expanding breadth, where a few securities start doing well at the beginning, and as a group starts to strengthen, more and more participate until you get to a point where almost everything's working. The problem is, this is where people are most confident and most bullish, and for it's easiest to make a mistake. What we care about is when the weakest securities in the group start selling off, while the leaders continue on. That tells us that the ice is getting thinner, where the leadership is narrowing, where there are fewer new buyers. And that causes us to get more defensive, to tighten up our stops, to raise a bit of cash, and to stop putting any new positions on in the universe that's seeing deteriorating breadth. Now, we run this model against 300 universes of securities across equities, fixed income, real estate, commodities. And our job is to pick our spots. So, long-winded way to get to the point, let's talk about leadership. So again, we don't have to be everywhere. We got to pick our spots. And today, it turns out that we continue to see sloppiness in our shorter-term indicators. We talked 2 weeks ago about the fact that our NYSE bullish percent model that tracks the percentage of stocks in the NYSE that are in uptrends had started to weaken again. We saw the same thing globally, percent of stocks in uptrends starting to weaken. Canada continues to be resilient. And that happens to match up with other parts of the world outside of the US that are a little bit more focused on commodity markets, like South America, for instance. Percent of stocks above the 50-day moving average moved a little lower this week. Percent of stocks with positive weekly price momentum also moved lower. And the percent of stocks trading above their 150-day moving average also weakened. So that means to us, we don't put on new positions. It means that we have tighter stop losses on our underlying current positions. And we continue to test our thesis. When we look at the model for the US equity market, this is a reading that tracks percent of stocks in uptrends. On the left-hand side is a percentage. These are years along the bottom, starting in this chart from 2008. When the percent of stocks headed higher starts to deteriorate, we mark out a falling percentage of stocks in uptrends in zeros. When we get below 30% and we see reversals up, it most often is statistically significant. So if we went back in time and looked at the most recent market lows, We know March of 2021. We know January of 2019. We saw February of 2016, October of 2011, and of course, one of the most important ones, March of 2009. So in June of this year, bullish percent, or the percent of stocks in uptrends in US equity markets, got as low as 20%, reversed higher. Now, it doesn't mean that that ultimately will be the low. Very often we will retest the lows, and you saw at the end of August, the percent of stocks in uptrends start to weaken again. So ultimately, my guess is we will see this bottom at a higher low, but I'm not going to guess. For now, we don't put on new positions and we look elsewhere. When we look at the Canadian universe of securities, our home market, it's a very small part of the world market, but there are parts of this market that are well suited to the environment that we're in. We saw this indicator bottom in July, reverse higher, and still very sticky. Percent of stocks in uptrends has not started to deteriorate in Canada. This indicator also saw an important low in March, the third month of 2020, reversing up at a time when it sure didn't feel like stocks should be reversing up. So we're more positive to the Canadian market. When I look at the TSX, going back to the beginning of this most recent pullback that happened toward the end of August, market's actually only down 2% over the last 17 days. Relative strength versus the S&P is rising sharply, outperforming the important market that we all watch. When we look around the world, there are a number of markets that are behaving a little better. Interesting, most of Asia Pacific showing improving relative strength and improving percentage of stocks in uptrends. Almost 50% of companies in the Asia Pacific market are in uptrends defined by a point and figure chart. Brazil is in the same camp. When we look at the Middle East and Latin America, both more commodity-driven markets, improved breadth there. And India, which has been well insulated from the outside world and certainly probably helped by inexpensive Russian energy, performing among about the best in the world. Canada falls in. We can see Europe in general having difficulty, and the US. It's about picking our spots. When we look at sectors, the XEG, or the Canadian Capped Energy Index, continues to lead with strong relative strength, up almost 47% on the year to today. Since the sell-off started again in the S&P, only down 4.5% over the last 10 days. And we've talked about the fact that in a more reflationary regime, oil and gas can become structurally shorted. In other words, not enough new investment to supply demand. We started seeing relative performance versus technology, a short duration asset that can see rising earnings quickly versus a long duration asset where the course is set for the next many years. Relative performance started to improve in 2020, and once it begins, it can go on for a long time. Now, keeping in mind when this bottomed, oil and gas was 2.5% of the S&P. Who cared? Especially after years of underperformance. There was underinvestment in the market, and of course, many large funds decided that they weren't going to own energy at all. Well, we know that since the low, we've been seeing higher highs and higher lows, higher highs, higher lows. This is for the XOP, which is the S&P SPDR Oil and Gas Exploration and Production ETF. And this just continues. We know that breadth within the energy sector continues to be strong and resilient despite the fact that markets are weak. We're seeing rising relative strength, rising point and figure charts. This is a group that continues to meet our tests and continues to be important. But outside of traditional energy, alternative energy continues to do the same. Relative strength versus the S&P for the solar ETF TAN has been moving higher sharply since May, now better than 92% of all the companies in the S&P. Today, in a very weak day, down 1.8%, more or less where it's been trading over the last 3-4 days, but we know it's trading above long-term and shorter-term moving averages. Continues to be one of the best looking parts of the market. Uranium, very similar, sharp relative price performance over the most recent number of weeks. The market believes that this theme is resilient because there are buyers in the face of weakness, and probably not hurt by the fact that Biden postulated that perhaps at $80, he'd be prepared to step in and start replenishing the strategic reserves. Nice to have a backstop. Industrials continue to have rising relative strength. Very weak day today, down 3.5%. Point and figure chart continues to be good. And of course, the defense sector within this group is one that's been leading. This is the series of higher lows and higher highs that we've seen since the market made its low in June and continues to act constructively. Investment banks, IAI, not exactly lined up with a collapsing economy. Maybe things aren't quite as bad as people think, but rising relative strength, again, down today, but certainly acting much better than the market over the last 6 months. Same for the consumer staples and the utilities. Of course, the most defensive parts of the market may well be that people are buying utilities for expanded demand out of the grid over time from electric vehicles. But again, really over quite a sloppy summer, last 57 days up 16%. And if we start from the beginning of the year, well positive on the year, much better than the S&P. They really feed into that dividend growth theme that we talked about last week as being a group that gives you a free lunch. We're seeing rising bottoms and rising highs, trading above long-term trend, continues to be very constructive. And we know that dividend growers tend to have better returns over time with markedly less volatility. So that's a free lunch. Other groups that continue to act well, miners, again, a reflationary asset through the pullback and bounce, and today's pullback down 4.8%. Very strong versus certainly the NASDAQ, which is down 10, 11% over the same period. Value continuing to be a component of the market that's acting well, rising relative strength, again, hanging in quite well against the sell-off over the last couple of weeks. We talked last week about our concern about the fact that the NASDAQ was unable to regain relative strength versus the S&P. Now, this is a problem because hedge funds, as of last month, were more heavily concentrated in the largest tech stocks than they have been at any point over the last number of years. In other words, they've continued to buy the weakness. Ultimately, if they decide they need to unwind this position, this can be problematic. And one of the most important groups over the last few years has been semiconductors, with a real rollover in relative strength. So what happened today? You get a down day in tech, down 5.7%, and a new relative strength low. So the crowded parts of the market continue to be under pressure. The groups that are more well-suited to an inflationary environment continue to outperform. I know that it's not an easy thing to fight the Fed, and we don't intend to do that. If price behavior changes or the breadth models change, we will de-weight parts of the market that we own. But we're not going out on a limb to try and pick a bottom in a group that everybody owns. NVIDIA, one of the most well-owned stocks across the market, today down almost 10%, with relative strength collapsing through this most recent sell-off. We talked about being short this last week. The communications sector is the same picture, continues to be very weak, riddled with heavyweights like Meta, which today made a new sell-off low, down almost 10%. Now, this shouldn't be a surprise that we're not there. If you look at the point and figure chart of Facebook, we made the ultimate high in September of 2021. Since then, we have made a series of failing lower highs and lower lows, lower high, lower low, lower high, lower low. There's no point in here where we can put this position on, no matter what our view is of fundamentals, clearly being distributed out into the market. So this really is a time where we have to pick our spots. Real estate is a place that we just can't go. Again, weak relative strength, weak breadth, and the same for consumer discretionary. Now down through this sell-off, 9% over the last 20 days. So it continues to be a market of have and have not. But also, weakness is spreading in the market, and we have to keep that in mind. We've got stop losses in all of our positions. Our very short-term government bond weight, which is just a place to hold liquid cash, is now 12% across the firm. We have close to 5% in cash and another 5% in corporate bonds, making a total of about 22-23%. Energy continues to be our largest weight at almost 4 times the market weight. Industrials a significant overweight, financials in line with market weight, and utilities almost 4 times the market weight. Consumer staples overweight, healthcare underweight, and then very low weightings in real estate, consumer discretionary, communication services, and a slight overweight in materials. And the reason it's not bigger is because it's a more economically sensitive group. Of course, that means there's risk. Almost no information technology continues to be in the portfolio. So I do these meetings once a week to make sure we're updating people, to show them that we are doing what we say we do. And it's really, really important at a time like now, A, to have flexibility, in other words, some cash or short-term deposits. B, to be in some of the stronger parts of the market, because we saw 2 weeks ago when the market took off, some of these big groups moved higher in a hurry, and you can't afford to be void of positions. And you also can't try to pick bottoms because that can hurt you. We're about 85% positioned in Canada, which is unusual for us, but the Canadian market is well suited to the types of sectors that are performing well. Outside of Canada, a few markets acting better. Japanese market, after many years of underperformance, is chopping its way higher. India, which we talked about earlier, one of the best performing markets year to date, continued to work its way higher above all moving averages. And Indonesia, interestingly enough, in Asia, a very small part of our weight, but a group that's seeing very sharply rising relative strength. We have to look at this work every day to say if it continues to hold. On the weak side, despite the fact that Europe is very inexpensive on an earnings multiple basis, relative strength continues to weaken. We can continue to be short Europe as a whole, and Germany in particular, as one of those countries most ill-suited to the problem that we have with energy in the world. So I do believe we continue to be in a structural bull market. I do think, though, we have to manage these drawdowns as best we can. When I looked across the portfolios at the end of the day today, depending on the mandate, they were down anywhere from 75 basis points. I think the worst was 2% against a market that was sharply lower than that. We've got to manage the positions. Things that give me some comfort. Volatility continues to make lower highs. The market at this point is not telling us there are much lower lows coming. When we look at credit spreads continue to be contained. In other words, bond investors are not saying there is some kind of a credit crisis like there was in 2008, which was a very different picture. In fact, where we sit today from a credit spread perspective, even much better than where we were during the COVID sell-off. We know that positioning in the market is highly defensive to begin with. There are no overly motivated sellers. Institutions have loaded up on puts, which most often is a contrarian indicator. It may often mean that if everybody believes something's going to happen, it doesn't happen. Last week, a record amount of premiums were paid to buy puts, dwarfing what happened in 2008 or in 2001 and 2. And we know that investors are not allocated heavily to equities. We know that historically, when the S&P is weak, investors take down their weightings. Often there's a high correlation. What's happened in this sell-off is, in fact, the selling in equities has been much greater than the damage in the market. I believe because investors in general feel like they've learned lessons, they have to take sell-off seriously. But it also means that this money can get put back to work. At some point, things are going to cool down, and the Fed will become more comfortable with the fact that they don't have to rate raise rates as quickly. It may not be now. It may well be that investors are concerned about the midterm elections. It may be that they're concerned about the war between Russia and Ukraine and the implications there. But these are all things we've been considering for months. And clearly investors have voted with their feet. What matters now is what comes next. So if things get worse, we're very happy to get more defensive. As it is right now, I'm very pleased with the way we're managing the decline, and we have lots of flexibility in the portfolios. We're now into the middle of September. The middle of October on, historically, is a much stronger period. Let's see what happens. With that, Pam, if there's any questions, happy to certainly answer them.
Thank you so much, David. So we do have a couple questions here. David, would you, Sebastian wants to know, David, would you agree that CPI is a lagging indicator and today's action is an overreaction? He says he's seen prices come down in most markets, and he says, thank you.
Yeah, certainly, CPI is backward-looking data, but I think there was some hope that we might see some of the components come down a little bit more. I think that when you look at some of the components like healthcare, when healthcare pricing starts to go up, it tends to be more sticky. When we look at housing, house prices in the US have started to come down, and that takes a couple of months to start flowing into rents. So we may see rents start to get better. We know energy is improving. We know commodity prices have come down somewhat, and we know that supply chains are starting to heal. So I understand that this was a little bit hotter than what people thought, but remember, if you've put a stake in the ground and are very bearish and very defensive, on a day like today, you're going to push on that trade. Let's see what happens over the next few days. And let's see what remains resilient and what doesn't. If groups that we're focused in get sloppier, we're going to get a little bit more defensive. But frankly, I'm surprised at how well some of these commodity prices have held in, given the fact that if we get higher rate hikes, that's going to be a headwind to the economy. What we didn't talk about today was small business optimism was actually up substantially more than what people expected. So there are pluses and minuses, but today the day was to focus on CPI.
Thanks so much, David. There's one more question here, and it's about inflation. This viewer is saying that inflation seems to be caused more by supply chain shortages rather than overspending. He wants to know, why is supply chain still a growing rather than a declining problem?
Yeah, I actually don't think that supply chain is a growing problem. I think that there are certain products that are in short supply, like some of the basic materials, which we've talked about. Part of that has to do with, COVID shutdowns in other parts of the world. Most of it has to do with underinvestment, and it takes a while to fix a structural deficit, say in nickel or oil. But we do know that inventories in the US are building rapidly. So a big part of the Fed's process over the last couple of months has not only been to say we are raising rates, but you should expect us to raise them a bunch more, and to be very public and vociferous about it. Now, before they went into the blackout period on Friday, there was something like 12 Fed speakers last week, all out with the same message: expect more hikes. What they're trying to do is to say to you as a consumer, you might reconsider spending if you think conditions are going to get tighter. And if you hold back on your spending, it allows the supply chain to continue to catch up. Now, there's real indication that the supply chain is catching up. There were reports this week out of Asia that transportation brokers are having a hard time filling containers or ships for this time of year, where they should be tight. Pricing for dry bulk shipping has come down very substantially, and trucking prices are coming down. So it sounds to me like supply chain is getting better. One of the biggest sources of inflation were used cars, where there were some failed auctions this week where all the cars weren't sold and the inventory starting to build on lots. So there are some things in the chain that are getting better. But today, the number that's backward looking came in a little bit more hot, and obviously the market cared.
Dave, thank you so much. That concludes the questions we've received this afternoon. And as always, I will leave you with the final word.
Well, folks, I appreciate everybody tuning in. When we started this, 2.5 years ago, doing this weekly, I didn't expect that it would be something that we would do forever, but I can't imagine ever stopping at this point. If you've got questions that we aren't answering, send them to us beforehand. I'd love to add them into our deck. If you got questions after the fact that we didn't answer, pick up the phone, give us a call, send us a message. We're a firm that has close relationships with our clients and an open phone line. So we're very happy to have these conversations with you. And so don't hesitate to reach out. Don't be shy. And otherwise, we'll be back next Tuesday. Looks like we're going to continue to chop our way through this difficult part of the year. But there will be another side, and we'll have lots of opportunity to take advantage of it. So thanks very much.